Hello, my name's Doug Lennick. I am here with Adam Recker, and we're here to talk with you about smart money and it moves. So today we're kind of excited. We're going to spend some time on interest rates. But before we get into that, I wanted to comment on our respective designations. You might notice that both of us are CFPs. And one of us is a CFA, that would be Adam. That means he's the smartest of us. And the other is a BFA, and that would be me. The BFA is a behavioral financial advisor, and a CFA is a chartered financial analyst. And these guys are serious. And we want you to know the difference because what we're going to be bringing to these sessions every month are the factors that go into the human behavioral side and the factors that go into the technical and fundamental sides of money. And so when we get into behavioral financial advice, I simply want to say this about it, and then we'll get on to the show. Behavioral financial advice essentially combines three disciplines. One is traditional finance, hence the CFP kind of stuff. Second is neuroscience, which is the study of the brain, the actual brain. And third is psychology, which is the study of the mind. And just to not be terribly confusing, let me say it this way. Think of the brain as the instrument and think of the mind as the musician. So we actually have an instrument and we have a musician. And so behavioral financial advice takes into consideration the musician and the instrument are two different things. And so we'll talk about that. So Adam, today we're here talking about interest rates. What do interest rates really mean? What if falling rates? Rates are falling. I love this picture. What's that mean?
Yeah, so clearly a complex topic, but hopefully by breaking it down into more digestible pieces, we can try to make sense of all of this. And so I think a good place to start really is addressing what happened recently. And so on the next slide, prepared an illustration. And so as many of us know, or if not, you're about to, recent Fed meeting, we had the first rate cut in some time now, about a year or so. As the chart shows, there have been some fairly recent cuts, going back to, October or so, but then had a bit of a pause here since then for a number of reasons. And these reasons haven't completely dissipated yet, but at this point, it seems like the most prudent thing to do in the eyes of the Fed was to lower rates ever so slightly as sort of a preventative or risk management measure. And so as we can see, we had a 25 basis point cut to the Fed funds
How
rate.
big a deal is 25 basis points? Is that a big deal, little deal? What do you think?
Truthfully, it is, in our view, not that big of a deal at this point. And in fact, it was maybe a bit reassuring than anything. A more severe cut, if they felt an urge to do maybe 0.5% or more of an emergency cut, could have set alarm bells off a bit, indicating there's a bigger crisis maybe brewing. But again, as the Fed chair said, Powell, more of a preventative measure, given that signs of weakness in the labor market, the overall economy developing. And so really trying to balance that perceived weakness that could be, approaching with the persistent risk of higher inflation, because as we can see here, with the CPI line kind of up and to the right, inflation hasn't moderated to the Fed's 2% target yet. It's remained stubbornly sticky. The fear is the ongoing tariff dynamic could keep them elevated, if not accelerating. And so the Fed is in a difficult position where they want to cut to protect the economy and stimulate lending, borrowing, things like that, but not do it to such an extent that inflation takes off again. Looking at that recent dynamic as well, you can see that looking at these rates, both the 2-year, the 10-year, much of this is anticipated by the market. And so the act of cutting is not the thing necessarily to always be focused on, because again, it is anticipated in many cases ahead of time. And you could see that by rates dropping ahead of the announcement. In addition, we throw out the 10-year rate because rates don't always move in lockstep either, as we'll show. And that can be an important distinction when it comes to both your sort of, financial life and the actual investments that you use.
Well, and then we throw around terms like inverted yield curves and stuff. What does that mean?
That's a function of really saying are short-term rates higher than long-term rates, and that can send signals from an investment perspective. Often, an inverted yield curve, when the shorter-term rates are higher than the long-term rates, that can be a sign historically that there's a higher risk of a recession. And so, there's all kinds of different dynamics that practitioners like ourselves are looking at to anticipate what may be coming and prepare for it accordingly. But looking ahead, I think, this is kind of where we are right now. We've seen a general drop in rates, especially at the short end. We'll talk about the impacts of that as well. But sort of reading the tea leaves from here, if we go to the next slide, thought it was helpful just to include the current Fed dot plot. Full disclosure, this can change on a whim, and it does.
That's just for us regular folk. These dot plots are kind of fun to look at. So just to humor us with, what does the dot plot say?
Yep. It's basically setting the Fed while maintaining a semblance of anonymity, we should say. Hard word to say, but I think you got it out there. Sort of forecasting what they see for the path forward is the idea. And so 2025, you can see many of them are, the expectations are grouped around about that 4% level where we are right now. Chance could have another cut or so, maybe by year end. And then the dot at the very bottom, that's the newest arrival to the Fed board, where wants to take a more aggressive approach, but a bit out of consensus with the rest. Looking ahead to the next couple of years, though, you can see that the general preference is to gradually lower rates. But again, there is quite a wide dispersion between the different views. And so the main takeaway as of today is the base case isn't severe cuts from now. It's more of a gradual approach as inflation hopefully moves towards a more neutral level.
Okay. Wow. Very good. So does this suggest anybody should, again, be doing anything?
We'll go to the next chart just to have it up, but I would say the more prudent set of or course of action is really to stay the course. Again, a lot of this is anticipated. There are some things worth considering doing. I mean, a key one maybe on the page here, the view here, really can affect short-term savings rates. And so one point of maybe consideration is that we can see that the effective federal funds rate, the rate that the Fed directly influences, is fairly highly correlated to 3-month treasury bills or even short-term savings rates. And so when, say, parking your cash at a bank or in short-term bonds like 3-month treasury bills or money market funds, there's a reasonable expectation that those rates are going to fall along with near-term cuts to the federal funds rate. And so the point to consider is while cash is always prudent to have on hand to a certain extent, we want to be careful about having excessive cash levels and maybe keeping it parked in those vehicles when there could be a risk that they could continue to fall. And so the trade-off would be, do we look to lock up some safe assets in maybe a 1-year, 2-year, 3-year instrument where we can lock in a higher rate as a sort of a preventative measure if these rates continue to fall? And so that's a conversation worth having with the wealth advisor. Other aspects, I would say, looking at things like mortgages, for example. If we go to the next chart in the deck, 30-year mortgage rates and mortgage rates in general aren't necessarily correlated to that short-term federal funds rate. They're more tied to a 10-year treasury rate, along with other dynamics like that influence those longer-term bonds, such as, are we concerned about inflation? Are we concerned about the ability to pay off debt and things like that, or even concerns about future economic growth. And so you can run into a situation where federal funds are lower, the short-term rates are lower, but the 10-year treasury or some of those longer term bonds may not move all that much, or they may go higher. And so it's not a foregone conclusion that a cut necessarily results in lower mortgage rates. And for that reason, we wouldn't be advocating to run out and try to refinance anytime soon. We would likely need more substantial cuts or other changes in the economy before we see significant movement from a mortgage rate perspective, or even things like home equity lines of credit, credit card rates, et cetera, car loans. It's a little
Well,
early
one
for
of
that.
the things too that we see, Adam, and psychologically, what, and clearly everybody understands when rates come down, people will borrow more money. So the psychology of this is it encourages debt. Now, what's interesting about that is debt over time produces a great deal of stress. So what we might adversely be doing is taking on debt, which will later bring us stress that we didn't anticipate. Borrowed money spends the same as earned money, but you have to pay it back. And that's the part that is stressful. So it's important that we understand that a lot of people out there, they see rates come down, they think, oh, good, I can go buy stuff now. And they take on debt that they really ought not be taking on, even though it's cheaper than it was just the other day. Any comment on that?
Yeah, no, I think you make a lot of good points. It's debt is neither good nor bad. It's a tool, but it's a tool to be used wisely. Um, Obviously, we advocate for a more wise use of debt. Um, a mortgage, taking out a mortgage can be productive if it provides access to an asset that provides safety, like a home, solid foundation for your life, et cetera. Or if you can even use it to invest in things that are expected to return at a higher rate than the debt you took out. But for the sake of just run of the mill consumption at higher rates, probably not the most prudent source of funds. But unfortunately, not everybody is left with a whole lot of choices either. I mean, the economy is sort of bifurcated, where there are signs that some of the lower earning, lower net worth are struggling more than normal, whereas many of our clients in particular, or people that we work with on a day-to-day basis, being fortunate, are able to do better than average. And so some unfortunately aren't left with a choice though. But still, they deserve the education, the guidance, and
Well, and we're here to provide that education. One of the things that we really want all of our viewers and listeners to understand that it's our job to position you such that when you need to get your hands on some money, there's a smart place to get it. I just heard someone say the other day, as it relates to a fiduciary responsibility, it's sort of, if you see something, say something. And it's our responsibility to point out to you if we see something that puts you in a little bit more risk than you should, or if you're about to make a decision that might put you a little more extended than you really should be. That's our job to help you maybe avoid those kinds of decisions. So our wealth managers are prepared to help you on both sides of these equations, but it's really important as you think about it and we think about rates. And I'll take it from there. Where do you want to go from here? I like what you're doing when you think about this in normal life and this in mortgage rates. What in general are your thoughts about mortgage rates? Are you seeing them? Do you think they're going to be coming down? Do you have a point of view yet?
Again, based on the forecasted cuts and where we are in the economy, I think the base case is that end at least next year, there's a good chance probably remaining above 6%. And so to really get a good benefit from refinancing, from what I read, my general rules of thumb probably would like to see rates down at least a percent or so before a refinance makes it worth it. Now, if you're in market for a home, maybe you don't put off the decision to buy just yet. Anticipation for rates, again, you can refinance later is sort of the wisdom behind it. The timing is never going to be perfect, and so we have to move on with our lives opposed to waiting all the time. Just be prepared to be flexible and refinance when those opportunities arise. But again, interest rates, albeit, are very, very difficult to forecast. I mean, we know that because even the people who set the short-term rates struggle with making the decision. And so more likely than not, though, it's going to be patient, wait a bit. We have things we're looking for, but there aren't a whole lot of important catalysts right now.
Yeah, well, we got it. We actually have, thanks to Mia and Deanna, they actually gave us some investor psychology things to comment on. So I thought it might be useful to actually do this, what's happening. So when we look at investor psychology and the next slide, you'll actually see some of the things that urge people to move. This FOMO thing, fear of missing out. A lot of people will go do something, and and we won't name names, but there are various TV programs you could be watching right now where they're going to be encouraging you to do something because you might be missing out. And that is a pretty standard approach that can hurt investors. Recency bias, assuming cuts will make the market go up. We're going to talk about that in a minute, what happens with markets with rate cuts, because the assumption often is rates come down, markets go up. And that isn't always the case. And we also think about interest rates and as they work on bonds. And people get confused also about bonds or what are called fixed income securities. The terminology can confuse people. Fixed income security. The part about that is fixed is the income, not the underlying security value. And as Adam, I'm sure people have experienced, there's an inverse relationship between the value of the security and interest rates. So as rates go up, the value of the security comes down, but the fixed income remains the same. And then this other thing, so these recency things can be a factor. Overconfidence, we all suffer a lot. I personally suffer from confirmation bias. We didn't list it, but I prefer data that confirms my position. And most people do. My guess is most of our viewers know what, as it relates to their political point of view, they know what cable programs to watch to be reinforced and what cable programs to watch if they want to get upset. And that bias that we have to look for reinforcing data is something we should watch out for here in interest rate environments. So be careful that you don't look for something that you get, but then it tells you the wrong thing. Anything you want to say to what I just babbled about for a bit there, Adam?
Yeah, no, I think this is great because while we're going to dive into maybe some of the more technical aspects of how rates can influence your investments, what you assume is going to happen is not always what happens. And so the point you made, rates fall, bond prices go up. Usually that's correct, but it also the magnitude can vary depending on how much the rates are cut and why they're cut and what bonds you actually own. And so it's not a foregone conclusion that a rate cut is good for every single bond across the board. Or the recency bias, we've seen this over the last 10, 15 years. There's sort of a perception that if any sort of risk starts to appear, the Fed is going to step in, prop up assets. And so it creates sort of a Pavlovian knee-jerk response that markets fall, we need to cut rates, stocks will go up. It creates sort of program by the dip mentality, and even sort of a perverse environment where at times bad news feels like good news, because any sense of weakness means, well, we're going to have more intervention and the party can continue. Because those lower rates have the effect normally of stimulating the economy, shoring up corporate earnings, lowering debt loads. And so it becomes fun and lucrative until it gets to the point that it's unsustainable. And so that's where, again, we're aware of these dynamics, and we have to sort of anticipate what could go wrong and avoid those two possible outcomes of excessive greed that can get investors overextending and buying riskier assets, maybe because yields are lower and it feels like you have no choice, but also avoiding greed or fear, I should say, when things kind of turn south and all of the things we had once assumed did not turn out the way we thought they would. Also not overreacting to that side and really staying the course through a balanced plan.
Well, yeah, I love how you're saying that. Reminds me of one of my sayings, almost nothing works always. And so we got to be ready for whatever could work. And that's, again, back to what it is that we, in fact, do. Let look at what does happen. So take a peek at markets. Let's see the next slide. Maybe you can speak to this.
Yeah, so hopefully it's not too busy, but try to pull some data to kind of talk through these points. And so a key question is, all right, rates happen. What tends to happen 12, 24 months or so? Like, there's different periods you can look at. The general good news here is you can kind of see in the chart 12 months leading up to the eventual rate cuts. Usually markets are pretty good. It's when they start to deteriorate, that's when everybody kind of comes around and says, all right, let's take some sort of step to intervene and make sure this doesn't turn into a full-blown crisis. Cuts tend to happen. Then following those cuts, generally speaking, risk assets like the S&P 500 tend to do relatively well following that. Albeit when we're actually running into a true recession, returns tend to struggle a little bit more than average. And so generally speaking, in the near term, rate cuts are viewed as more of a positive. This also sort of feeds into that severe cut. There's 50 plus basis point higher, more severe cuts as sort of a rushed cut. That's where it would have been a little bit more alarmist, because you may be looking at more of that recessionary scenario. And that hasn't happened, which I think is a good thing. On sort of the next page, I would say, or the subsequent slides talking about the fixed income, this kind of touches on that exact previous point. BlackRock had pulled some great data on, I believe, this slide and the following one, kind of speaking to this, where if you go back up to the first one for one brief second, the shorter term cuts, less than 1.5% of cuts in sort of that cutting cycle for the federal funds rate tends to benefit bonds for the most part across the board. You can see positive returns. However, 20-year treasuries, very long-term bonds, maybe not as good. The key reason for that, there could have been maybe more inflationary concerns kind of propping up the long end of the yield curve. It also could be because equities are doing real well, so maybe there's not as much demand for longer-term bonds. But generally speaking, positive returns. When we see more severe cuts, 1.5% or more over the course of a cutting cycle, again, lower rates, falling rates, generally good for bonds across the board. Not so great for short-term rates, because that's what's directly influenced. You won't have as much income coming from those due to the lower rate at that segment of the bond market. But some of the more longer-term bonds, like just general Barclays aggregate bond universe, corporates, intermediate term treasuries, high yield, and longer term bonds may do much better, often because there may be a flight to safety too, along with those cuts in rates, because the equity market isn't doing as well. And so, too early to tell at this point, but there are some potential outcomes depending on the rate of cuts and the magnitude of cuts to be aware of that we're constantly monitoring. And then I think finally on the next slide, kind of tying it out again, kind of just going back to assumptions. We don't want to assume anything. Rates may be forecasted to fall because of cuts to the near term based on the federal fund rate falling. But that's not a foregone conclusion that looking ahead, longer term rates or even some of the intermediate term rates necessarily fall either. It's entirely possible that short term rates can fall, longer term rates could rise. And so it's just, we just do not want to assume that everything is going to fall across the board, because that is not necessarily what happens. Systems are way too complex.
When we commented on that a little bit earlier, we've been talking about investors and how investors behave and how all that influences us as investors and as consumers. What's the so what of all of this relative to the federal debt? I mean, how big a deal is that as it relates, because sometimes we think it's all this private stuff, but the federal, how much the Fed has to pay to carry its debt matters to businesses and to consumers a little bit, I think. Talk about that I know we don't have a lot of time, but any comment there?
That is admittedly a tough one. Intuitively, it seems like deficits should matter. It's mattered for many countries throughout history. And again, I think a key reason for wanting rate cuts, it's to make our debt less expensive, has been one of the stated, reasons. And so I think there is some direct acknowledgement from the government that deficits do matter. And so they're taking steps, whether it's through tariffs to try and create revenue to pay off the debt, or even allowing a little bit higher inflation than normal to sort of erode away the value of the debt. They are taking steps to acknowledge it. Of course, you could also cut spending. That can be also painful. So clearly trying to take some other steps first before resorting to those measures. And so I would say they do matter. But to what extent? Fortunately, we are sort of in an enviable position, being the reserve currency of the world at this point. It gives us sort of a pass relative to what other countries have had to deal with. So hope that helps a little bit.
No, that helps a lot. I appreciate you commenting. Helps me, and I guess I'm kind of like a lot of our viewers. It helps them too. Let's get to some key takeaways, and then we'll wrap it up.
Yep.
So you want to go first, and we'll just talk together. How about it?
Yeah, sure. And I think I did browse some questions also, and I think it's tied to some things we were talking about before. But rate cuts, they matter. They shape borrowing costs, savings, retirement income, even from a borrowing perspective, like mortgages we talked about. Probably not a catalyst to drive mortgage rates substantially lower. But that shouldn't be a reason to avoid buying a house necessarily either. I mean, people ask, what if you're a first-time home buyer? You've got to start somewhere. And so, buying a starter home, you don't have a choice, so you have to take what you're given and then you adapt. Many have shared, clients, family members, the like. Mortgage rates have been much higher in the past too. It's possible they could go up more. And so you kind of have to play the hand you're dealt, but be willing to adapt. And again, we can provide the guidance there to help with that.
Well, and that's why the advice relationship is an ongoing relationship. It's not like we do a plan and we're done. I mean, life is dynamic. Stuff happens every day.
Right. And I think hopefully looking at the data here, it should be very clear that there's a lot of paths that the market could take, rates could take, and there's effects, there's things to do about that. It's the changes that are going to happen, kind of the second bullet point you had here, it's how do we react to them? And there's the behavioral side, how do we react to it? And how do we kind of synthesize all of that data as well and make prudent decisions based on the data that we have available to us matters. And so these are all decisions that are based on long-term data and understanding of psychology and how people react, given we're in the business of working with people, not just emotionless investments.
Well, and what a great way to end our program. We're in the business of working with people, not just emotionless investments. And so we really appreciate all of you people who joined us. Adam and I look forward to this every month. And I'm the one who sometimes forgets, I did again today, to ask that you can ask questions live. You're welcome to do that, so I apologize. So come back next month, give me another chance. Thank you for being here. We look forward to seeing you next month. Keep in mind that smart money moves.